I guess I want to understand, how has the investment environment changed most meaningfully over the last few years? And I'm going to put Jordan on the spot and start him off and say, you're talking to clients and investment committees every day. What do you think has changed the most in the last kind of 5 to 10 years?
Yeah, this is a chip shot. I'll take the first easy one off
Yeah,
the table. I think Victor couldn't hold back from almost saying like, "Hey, I think something's changed in fixed income." I usually talk about the 60 more than I talk about the 40, but you can't ignore, right? We had multi-decade bull market in bonds, more than a decade of trying to stimulate inflation. Finally got it. The outcome is, higher rates, term premium, and a big change underway in correlations between bonds and equities, which has pretty profound implications for 60/40, in particular the volatility of 60/40.
got it, Todd. I'm going to throw it over to you next. Of those changes, and through Vanguard's lens, what's your structural and what's your temporary in your view?
So what do you mean by that? What do you mean by structural
Well, I
versus
mean, do you think
temporary?
we're in a structurally different environment? Are we in a new regime, or are we in a temporary regime and, it goes back to looking like something from the last 30, 35 years?
Sure. So I think certainly within fixed income, as noted, fixed income yields are up, more than double what they were just a few years ago. So if you couple that with what we've seen in the equity market, very strong returns, very high valuations, it was looking like it was going to be a dimmer decade ahead for the 60/40 because you had very low yields and elevated valuations. With higher bond yields, you don't need as much from equities to achieve, you know, maybe slightly lower historical returns for the 60/40. So I would say, yeah, again, the big thing is fixed income. Higher yields means less work needed from equities.
Got it.